What's up, Texas? Woo! It's really good to be here. For a lot of reasons for me personally. One, I'm a native Texan, so I was born and raised in Dallas. I live with my 3 kids and wife over in Dallas, so it's good to be here in Fort Worth. I have a buddy in Fort Worth that I haven't seen in 2 years, and he happened to be out of town running an Ironman, so I was like, I can't see him this weekend. Another reason is I've recently joined Coinbase. I was at BlackRock for the last decade or so. My last role was head of pensions for iShares. So I've served the pension community for a very long time, so it's a distinct pleasure for me to talk to the Texas pension community here today. So thank you for having me, Art. Before we dive in, I just want to take a quick show of hands from everybody. Who here has a Coinbase account? Like probably 15% of the room, maybe 10 to 15%. So congratulations, you've just shown the rest of the room that you lost a lot of money recently in cryptocurrency, and they're all wealthier than you are. Crypto is a volatile asset class, and I use the term asset class. Do I have a ticker or a clicker thing? There it goes. Sorry about that. The middle button. There we go. We're going to talk about digital assets and financial innovation. You'd think I could use technology working in a tech firm. Disclaimer, none of this is investment advice. I'm here for educational purposes only. Most of you are probably here for your PAs and your crypto trading rather than true fiduciary investment. I would like you all to please go ahead and write down my email. I'm here for questions. I run the institutional business for Coinbase. My role here is to help Coinbase talk to pensions about digital assets and ultimately what is this technology revolution that's happening that we're in the very early stages of, but you will be dealing with it from your managers and your hedge funds and the different allocations that you already have over time. So please, it's pretty simple. Anthony Bassili at Coinbase.com. Hit me up on LinkedIn. So we're going to talk first about 2 digital value kind of spectrums. So one is Bitcoin, the store of value. Our friends at TriLink talked a lot about global currency risk and the Japanese and the Chilean story. I love that because they didn't agree on using any other currency besides the store of value. Today, Bitcoin is viewed as at least a competing store of value. There's another major network, which is the Ethereum network. That network is viewed as a platform, but both of these are cryptocurrencies. And ultimately, though, I'm going to go really deep into blockchain technology. I'm going to talk about how blockchain technology works and try to give you guys a framework for thinking about it as an investment. We're going to cover a little bit about, from a blockchain perspective, consensus mechanisms and use cases as well. So where are we in the cycle of digital innovation? Right now, we are 15 years really into the blockchain digital innovation, which surprises a lot of people when you think about that, but the Bitcoin white paper was released, the Bitcoin network was released in 2008. So at the depth of the financial crisis in 2008, the Bitcoin white paper was released by an anonymous person named Satoshi Nakamoto, and now here we are 15 years later, and we have a $2 trillion asset class. I use the word asset class because if you think about the size of the crypto ecosystem today at $2 trillion, compare that to the size of private credit, which we saw, which was a couple of $1 trillion earlier in these presentations, with a lot of room for growth globally, which I agree with. Compare that to hedge funds. The hedge fund industry is about $4 or $5 trillion. Private equity is probably bumping up on $10 trillion. So crypto is $2 trillion, smaller, but still very large, and an important ecosystem for growth. All of that value was not built overnight. It was built on layers and layers and years of technology infrastructure. And this is the story that most of you in the room have been a part of back in the 90s and in the early 2010s. In 1995, when you all got your first PC, at least that's when we had one in my house, I was very lucky, and you go to pizzahut.com, because that's the first place that you go when you get your first PC, and the internet's a thing, and you want to order a pizza. You can order a pizza, but you can't pay through pizzahut.com in 1995, right? The mechanism wasn't there yet to transfer value across the internet. When you were in AOL and you were chatting with somebody, you couldn't chat with somebody outside of the AOL ecosystem, right? And email also faced the same problem. There was a key unlock for Web 1, as we call it, and that was cryptography and standardized protocols. So the entire ecosystem of the internet in Web 1 and Web 2 over time had to develop standardized processes, standardized protocols, right? And these protocols defined how one application, like an email, is going to be constructed, and how the other application, user B, is also going to construct their email so that they can talk and share the same message. So standardized protocols was a key unlock in the mid-90s, and then cryptography was the other key unlock, which was how do you protect the data, right? Nobody really wanted to use email in a unsafe way, or I should say in these protocols that didn't have the cryptography, because anybody could hack it and you could read it, right? And there was no safety there. So it took cryptography to make people comfortable with putting their information out there. And here we are today, getting our eyeballs scraped by every data provider, every centralized social media company in the world. So for crypto, the same thing has played out. We've had the protocol layer with Bitcoin. Where's the button? Bitcoin in 2008. Coinbase was established in 2012. That was kind of the protocol era. This was the infrastructure era, which was when Ethereum was established as a blockchain. And then from 2017 through 2019, you had a lot of use case build out. So you had a stable coin, which is a dollar-backed digital asset. You had Compound, which is a lending platform, and you had a lot of innovation happen here. So protocols were built, things were built on top of it. Here we are today, where we expect, we're at the very beginning of this cycle, but we expect a tremendous amount of activity on digitizing assets, right? And so basically, take an asset that doesn't really have a market and isn't liquid, can you, like a commercial, like a deed, right, or house, right, things like that that aren't necessarily liquid, can you tokenize them and represent the asset on chain, and is there a market for you to trade that, right? That's what's happening today. Now, it's already happened. The $2 trillion of assets that are already digitized are pretty much crypto native, right? Those assets today that you're all trading on Coinbase represent companies or applications inside of the crypto ecosystem. What is coming is real assets being digitized and added to that ecosystem. Okay? So what is it that gives a digital asset its key features? And before we talk about the assets themselves, the key features of them actually come from the blockchain that they live on. A blockchain is a decentralized blockchain, I should say. Like, there are centralized blockchains. It's a database. At the end of the day, it's a settlement layer, right? It's where transactions and information is recorded. And the difference between a centralized and a decentralized database is that in a decentralized database, no single party controls the data and can change the data that is in there. So if you have a transaction, or you want to make a transaction and you want to be able to do it without any intermediary stopping you, which we hear a lot about in the news today, then you can do that on a blockchain. So what features of a blockchain are, they're global. Where's my button? Oopsie. How do you go back? Hold it what? There we go. A blockchain is global and borderless. It's decentralized and they're transparent, and importantly, they're open source. Any one of you, Art, we could, after this, if you want, we can actually create a Texas pension blockchain where all the pensions get together and just trade assets with each other, right? That's possible. They're open source. So you copy the code, you relaunch it on a network, and now you have your own blockchain. They're composable. So what that means is because everything is built on code, you can put things together, right? So one token that represents one asset and another token that represents a different asset, you can effectively combine them through code. And so you get the tokenization of assets. So digital assets get the properties of a blockchain, right? And the open source nature is the thing that's really important. We've heard today, I think, a lot about private credit, and private credit's a great industry. And private credit was the result of regulations that restricted banks from lending in 2008 because they were trying to control the concentration of risk, right? That also impacted liquidity from the public markets. Private credit's a great industry because it's effectively diversifying and allowing more and more investors to get access to the loans and the credit that they need so they can run their businesses, right? So that process is playing out, and it was actually driven through regulation. The process will continue to play out because this is all about access. We heard our reference TriLink. He referenced trillions of dollars of money that doesn't have access to capital, right? So when you think about blockchains that are global and they're borderless and they're permissionless and they're open source and they're decentralized, And no single party, government, or anything else can interfere with a lender or an investor or a borrower and their ability to access those financial systems. That's what a blockchain is for, right? This thing does and is and will continue to scale globally, and anybody can get on there. Everything I talk about today, you can all do yourselves, and also our institutions can do, right? And that's all about access. So it's a wonderful system, and we'll keep it going. So I'll start with the biggest one. So it's a $2 trillion, the value of the crypto asset class is $2 trillion today. About 40% of that value is tied up in one single network, and that is Bitcoin. We talked a little bit about Bitcoin. Bitcoin is an open source, peer-to-peer, decentralized, permissionless settlement layer. It allows Peter to send a Bitcoin to Paul, and then to do that over and over again, and nobody can stop that transaction. Trading Bitcoins can be stopped at the kind of user layer. So if you're trying to move your money around to a bank or spend money on things in real society, right, there's gates for that. But if you're on the network directly, nothing can stop a transaction of Bitcoin. Now, there are about 40 million Bitcoin holders globally. I think that number is actually closer to 80, depending on what data set you're using. Estimates are around 100 million total crypto holders in some way or another. But the big question is like, where does Bitcoin get its value? And there's a concept of digital scarcity. In digital scarcity, there's a lot of ways to look at it. There's two primary ones that I'll talk about. Number one is about money supply. So when the Bitcoin network was released onto the internet, it's a smart contract code, right? It's a piece of code, and it's defined to have a fixed money supply. So there will only ever be 21 million Bitcoins in existence. And when it was launched, there were 0, and then miners were processing the Bitcoins, and then here we are 15 years later, roughly, and we have 18.5 million of those Bitcoins that have been mined, right? And then we've got 120 more years, right? So in the year 2140, the last Bitcoin will be mined, and there will be no more Bitcoin supply coming onto the market. So you get this concept of digital scarcity. The Bitcoin network was encoded with a fixed monetary policy, which means that basically right now you're seeing about 3% inflation, and it's hard-coded in. And that inflation rate gets cut in half every 4 years, consistently, until the year 2140, when the last Bitcoin's going to be mined. So all these miners are out there, and in Texas here, we know all about them because, God bless China for kicking out all the miners because they came here and they're buying up all of our energy, which is great. And we like to keep these things in the US, right? I think the Bitcoin network is going to be really good for us, geopolitically. So in the year 2140, the last Bitcoin will be mined. There's digital scarcity. So people look at that and they say, well, I know that this asset that maybe 100 million people are trading around the world, and I really can't be stopped for using it if I want to settle money there, is deep and liquid and transferable. And I know that it has a fixed 3% inflation rate that will continue to go down, right? Then I think it's a pretty good store of value if I'm sitting on versus holding the dollar that I know is 7.9% inflation rate most recently, right? That's obviously going to change over time, but there is an option versus fiat currencies, right? And no government or central authority can change that inflation rate. Now there's another aspect of digital scarcity, and this one has to do with blockchains. So a blockchain is a settlement layer that holds information, transaction data. And every single block, because it's a chain of blocks, has a finite amount of space. So every Bitcoin block holds about 1 megabyte of information. And so when users are trading and they want to push a trade through because they're taking advantage of an arbitrage or something, right, they want to make sure that that trade goes through and settles on the chain. And once it goes through and settles on the chain, then it's reflected and the whole world can see it because it's open source and decentralized. But that space is scarce. Right? So blockchain space, right? The ability to have your information housed on a chain forever, and it cannot change, is a scarcity element. So there's a lot of value there. Which brings me to Ethereum. So Ethereum is, think of it the same way as Bitcoin. It's an open source, decentralized ledger, and it's a settlement layer that allows people to move assets and tokens around, right? Just like Bitcoin and ETH. The difference is Ethereum is built so that you can build on top of it. So you can actually build businesses on top of it, build technology on top of it, build applications on top of it. And those businesses on top of Ethereum allow users to transact different things. It actually allows you to kind of canvas real world use cases rather than just sending Bitcoin around the world. And so it's seen as the, maybe it's the full computer, as people like to say. Bitcoin's like a calculator and Ethereum is the full computer. So it's a platform. I compare it to the Apple iPhone, or I should say the iStore, whatever it's called, right? You've got a central party, which is Apple. They created the iOS operating system, and then now millions and millions of people can build applications and put them on the iStore, and anybody can engage with those applications as long as you own an iPhone. The difference with Ethereum is that you don't need to own an iPhone, you don't need to own a computer, you can go to the library. As long as you can get on the internet, you can access that entire ecosystem of applications on the Ethereum network. So what? Let's talk about how deep the market is, right? So fine, you've got these settlement layers. They allow millions of people to access applications and do interesting things like store data. That's cool. You can hold ETH and BTC, which is Bitcoin, right? Those are tokens you can buy and sell. Most of you can probably get it in your PayPal account now, your Venmo account, right? You have your Coinbase account. Like there's a line of banks around the block trying to integrate Bitcoin, the ability to buy and hold Bitcoin and ETH for you as users right now. It's a deep market. So over 2021 and over the entire year of 2021, looking at centralized exchanges, we saw around $300 to $500 billion of volume across top 10 or 15 centralized exchanges. So that turns out to be about $10 to $15 billion per day. That's a really robust liquid market. So you compare that to the high yield space, right? High yield cash bonds trade anywhere from $6 to $7 billion a day. The two most liquid ETFs that represent the SP 500, SPY, and IVV, those are trading around combined $10 billion a day, right? Those are the most liquid instruments on earth, right? And Bitcoin and ETH are trading just about that, if not more, right? So it's a really deep market. So when clients ask me, like, is this ready for institutions? I say, well, portions of it are, right? And these are the base networks of Bitcoin and Ethereum. And if you go down the curve, you start to see a drop off in liquidity. But we're going to focus on these ones. So then you go, how do you measure it? You measure daily transaction. How do you measure the value of this network? Right? We talk about digital scarcity again. 1.2 million daily transactions are settled on the Ethereum chain, right? And so there's thousands of applications and millions of users, and they're all doing stuff like sending money around and betting on Dogecoins and things like that. 1.2 million daily transactions. In 2021, the Ethereum network settled $6.5 trillion of value. That compares to Visa, which settled $13 trillion of value in the same year, right? Which is kind of mind-boggling to think about because everybody knows Visa, right? You use it every day. The Ethereum network settled half of that network's value. So what does all that translate into as investors? So as investors, you go, there's a tremendous amount of demand for block space. Every time somebody does a transaction, so the 1.2 million transactions, every one of those incurred a transaction fee, which is called a gas fee, and every one of those gas fees then is collected as revenue. In 2021, the Ethereum network captured $10 billion in revenue, and it was 50% of the top 10 applications, the decentralized applications that are crypto native. And so you see this is Ethereum, the green one. Now what's interesting is there are competitors. Binance Chain is literally, it's a Chinese cryptocurrency exchange. They copy and pasted the Ethereum network and changed a few things to reduce the cost of using the network and centralized it so it's not as decentralized, so it wouldn't be as trusted as a settlement layer. But they generated a couple $100 million in revenue. Uniswap, which is built, it's an automated market maker, so it's a decentralized exchange, was built on top of Ethereum. It was really the first one that really kind of was an unlock from a liquidity standpoint, generated about $500 million in revenue. Oh, sorry, $1 billion. There was $1 billion in revenue last year in 2021. And you can go on and on, right? These applications, so a lot of these applications are built on top of Ethereum, and they're crushing it from a transaction fee perspective, and they settle on Ethereum, and then Ethereum makes money as well. So it's a really incredible model, right? And then you got to ask yourself, well, how do I get some of that? I guess, right? One way is to hold ETH, right? Which, if you believe that the world's participants will continue to want to access decentralized permissionless settlement layers and build applications on them, there should be continued demand for block space, and therefore they should continue to pay transaction fees, and therefore you should continue to see a revenue model that continues to move, which I think is really interesting. Compared to the Bitcoin network also has fees for people to move Bitcoin around, but it's much smaller, and the Bitcoin generated about just shy of $1 billion in 2021, so still not small. But different use cases, I like to say. Now, there's a new adage that says blockchains are in the business of selling blocks, right? We talk about block space, like that's what they sell. So it has to be a trusted settlement layer. So if you're thinking about like, where do I want to put my information out there? I want to put it somewhere where I trust that somebody isn't going to misuse it, right? And I know my transaction is going to settle, right? That's what a blockchain sells, is that space that people can trust. There's two ways that they validate that trust, or actually like promote that trust. So every blockchain prints money, effectively. They use emissions. So I mentioned the Bitcoin blockchain has about a 3% inflation rate. So miners come in and they solve the computational problem that is transactions to create a new block. They get rewarded in more Bitcoin. There's about 6 Bitcoin per block that's generated. That's a new Bitcoin right now that's generated. It's worth a couple $100,000 at current prices. So the proof of work is the thing that everyone's generally familiar with when they think about Bitcoin. Proof of work is basically a game of partners out here. You guys can all go buy computers, go buy ASIC chips, and go co-locate yourself next to cheap oil and gas, and whoever can spend the most money to try and to solve this computational problem, to produce the next block, you're going to win the race, and you're going to capture the Bitcoin reward, right? Proof of work is an energy suck. It's a massive computational suck, right? It's a good way to do it, but it doesn't seem like the most sustainable way to approach blockchains long term. So the industry got together and said we need to come up with a more sustainable way that's more efficient and safer and more secure. Proof of stake is the new model for keeping a blockchain safe and secure. So proof of stake is basically, I know we're in Fort Worth, Texas, and I'm just before lunch, so most of you are thinking about steak. Proof of stake is a process of basically taking collateral. So you all in the room, as institutions and as individuals, can buy Ethereum, and then you can stake it to a validator. Coinbase runs a validator. We run multiple validators on our client's behalf. You stake it to a validator, so you give them your ETH. We commit it to the security of that network, and then you reap rewards for doing that, right? So a big piece of the Web3 ecosystem is about rewarding its users, right? So if you want to be a part of this ecosystem, you'll buy in by buying the tokens, but you can also put your collateral up and they get rewarded for being a part of that security mechanism. It's a big topic. It's a complicated topic. But I think the thing to understand is that proof of stake is the future of blockchains. Proof of work is probably largely going away, except Bitcoin might be around for a while. Right now, there are about $340 billion in market value of proof of stake chains, different chains besides Ethereum. Ethereum right now is a proof of work chain. It's converting later this year to a proof of stake chain. So that's the other chains that are proof of stake. This is the Ethereum chain. So we'll see close to $900 billion of value represented in proof of stake blockchains that all do different things. The rest of that is proof of work, largely Bitcoin. In the last 3 years, we haven't seen any proof of work chains really take off. They've all been proof of stake. Right now, we're seeing about 25,000 ETH staked per day across the ecosystem, about $75 million per day. So this is investors buying ETH and then choosing to lock up their ETH for a period of time so that that money or the asset can be used as part of the security mechanism for that blockchain. Now, when what we call the merge happens later this year, the Ethereum chain is going to go from a proof of work consensus mechanism to proof of stake. And what's going to happen is a lot of the throughput of the chain is going to improve and be much faster. The security mechanism is going to change from proof of work to proof of stake. All the folks who currently are locking up their assets, they're going to continue to be locked up, but the reward rate is going to go up dramatically. So right now, Ethereum is about 4.5% inflation. It's going to drop to 45 basis points. But the fee revenue is going to continue to go up. What we're expecting to see is a network reward to institutions and folks who stake of between 8 to 12% APR. So when you stake, you then get rewarded back in ETH, and you could sell that ETH and convert it to US dollars or something else that you want. But this is a meaningful return, right? And difficult to find in public markets, if not impossible, right? And from a cash flow perspective, right? You'll never find it in the bond markets. You'll probably get it in private credit or some other places, right? This is a meaningful return. And I think the thing that I don't want folks to get too hung up on the number, but just the fact that as you represent pensions and you represent your underlying participants, and you want to find ways to have diversified income streams, right? This is a diversified income stream. You still hold the volatility of the Ethereum asset itself, but you've locked it up, right? And you're comfortable with a long time horizon for that network to grow, and your expectation there is that the network growth of the Ethereum network will eventually continue to realize in like this payoff over 5 years or so. So that's staking. I think I'm at time. So I'll wrap up if we're going to go a few more minutes. DeFi, decentralized exchanges, asset tokenization, and adoption. So what is DeFi? So all of the activity I talked about is through a number of different applications. The most popular one is decentralized finance. And effectively, when you think about that, you go, if I want to put an equity trade out, I have to go through a broker who has to go through DTCC, who has to go through my custodian, there's confirms, there's clearing, there's all this kind of stuff. There's about 13 to 17 different intermediaries in order for us to trade a liquid public equity. That entire process and all those intermediaries have basically been collapsed into code. Uniswap is a great one. I mentioned Uniswap is an automated market maker and exchange, so it's decentralized. They generated $1 billion in revenue last year. They are built on top of the Ethereum blockchain. And what they do is allow you to make new markets. And it's super interesting. So if you go, like, I'm sitting on widgets, I'm an institution, and I have a bunch of assets that aren't liquid, and I can't really do much with them, and they're not productive, and I don't want to hold them very long, but I can't sell them because I'm going to probably eat my lunch on them. What do you do with them? What if there was a market for those assets? Because you know that every other institution in the world has similar assets, and they would love to trade them too, right? Can you standardize those assets and then go into the Uniswap decentralized automated market maker and create a new market by acting as the market maker yourself? And that's exactly what happens on Uniswap that folks are doing with tokens of all kinds. So I think we're going to see new markets that we don't know exist yet, right, be created on top of the blockchains. As we go forward, more assets are going to be tokenized. These are all the use cases right now that exist. You'll see traditional financial applications and companies be the new wave of them, right, are decentralized. So Maker is a borrowing protocol where you can put your US dollars and borrow digital assets. Compound and Aave, you can put any kind of asset that's digitally native in there and borrow against it at super low interest rates right now. Balancer and Uniswap, I mentioned Uniswap. There are native asset managers where you can actually deposit into vaults, and those asset managers are investing it for you, finding yield and other investment opportunities natively in crypto. So a lot of interesting stuff here. But every sector is going to be and continues to be, I would say, improved. Not necessarily disrupted, right? We thought websites would take out all brick and mortar, but we're still going to, bookstores, and we're still going to Walmart. And although I love my grocery delivery now, it's pretty awesome. But it took a long time, right? So I don't think the disruption is going to be, the same that people expected in the internet in the 90s, right? But it's going to be improved. Most of the people in the world aren't going to notice that the higher yield in their account is coming from a blockchain, right? Most people are not going to notice that there is a blockchain settling their transactions. They're just going to be offered new, interesting products to invest in. The DeFi ecosystem has about $120 billion of value locked with 4 million wallets, or we call them people, interacting in different ways, right? So it's a pretty deep market. A lot of stuff happening there. And I talked a little bit about asset tokenization. So institutional adoption, I'll close here. There was a survey done back in 2020, late 2021. About 33% of the respondents said they were actively researching or investing in crypto. This is institutions like family offices, endowments, high net worth, financial advisors. You can see pensions, which is basically hadn't started yet. So a very small amount of pensions are invested, but I can tell you that I'm here to tell you that if you'd like to talk, please contact me. This is an interesting, diversified asset class that I think is going to be around for quite a long time, that pensions should start thinking about their digital strategy. Coinbase, we're one of the gateways. We're the largest U.S. exchange for crypto in the U.S. We're one of the top 3 in the world. We're the largest U.S. crypto custodian. We're a qualified custodian. We're a public company, and we're working with just a lot of institutions. So we have our retail business, which you all probably know about. This is Coinbase Prime, which is our institutional grade business. We're working with lots of companies to help them launch NFT marketing strategies and things like that, which your kids will be buying, and you probably won't be happy with how much they paid for them. And then we have a cloud-based service for developers as well that we do. So there's some stats. But thank you all so much for having me. I hope this was educational. And please email me if you have questions.